Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section A2. This is an application topic. Perform procedures, and that would be things like agreeing information to original sources, validating search or query criteria used to obtain data. So we are performing those procedures. To validate the reliability, and that would be things like completeness, accuracy, authenticity, and susceptibility to management bias of data and information obtained from internal and external sources. And so that would be things like analyses, schedules, reconciliations prepared using various technologies, including artificial intelligence. So quite the mouthful for this topic, but that is what we're going to be going over today. And we are going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's 1 hour, it's free, and we will teach you in that 1 hour the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the full 10-question versions of these 5-question YouTube videos. So in today's video, we're only going to be going over 5 questions, but if you become a SuperfastCPA Pro member, you'll get access to the full 10-question versions of these videos so you can get a little bit more help and a little bit more understanding. So make sure you check out becoming a Pro member as well. With all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out is reading the last sentence of the question first. This is a great strategy for test day because you have no idea what you're going to be seeing on the exam, and reading the last sentence of the question first gives you frequently that context for what the question is about and what you need to be kind of looking for as you're reading through the question. So read the last part first to kind of get an idea of what you're dealing with, and then read through the rest of the question. So we're going to do that here. Which of the following sources would provide the most reliable evidence of ticket revenue? Let's go up to the top. An auditor is reviewing the ticket revenue of a professional sports stadium to determine if it was recorded accurately. The stadium's management claims that a recent championship game was a sellout, and they provide several sources of data to support this claim. The auditor must determine which source would provide the most reliable evidence that all ticket sales were recorded correctly. Okay, so again, which one of these sources would be the most reliable evidence about this ticket revenue? Let's go through the options. Option A, a spreadsheet maintained by the stadium's ticketing manager, summarizing total tickets sold and revenue collected. B, the stadium's point-of-sale system reports, which list all tickets scanned at the entrance gates. Option C, bank deposit records showing total credit card payments received for ticket purchases. Or option D, a survey of fans conducted outside the stadium where attendees were asked if they purchased their tickets through official channels. Okay, so again, which one of these is going to be the most effective in providing the most reliable evidence? If you don't really know, or if you don't really understand the concept behind this question, that's okay. We are using these questions to learn what we're supposed to know for this topic. So let's go ahead and dive into the explanation together. All right, here we are. The answer is C, bank deposit records showing total credit card payments received for ticket purchases. So this would be the best for reliability. Let's walk through this. The most reliable evidence is typically external, independent, and directly tied to financial transactions. Bank deposit records provide third-party confirmation that ticket payments were actually received, reducing the risk of overstatement or manipulation. So we learned something really important there. When you want to make sure that something is accurate, the thing that is the most reliable would be something that is external, so a third party that is independent and giving you that information instead of it coming from the internal company. Now let's talk about the other options and why they're not quite as good. Option A was the ticketing manager's spreadsheet. While this could be useful, this is internally generated and could be manipulated or contain errors. Option B was the point-of-sale system reports. These show scanned tickets but don't confirm all ticket sales were recorded as revenue. So that would be, because there could be things like complimentary tickets or fraudulent transactions. And then option D was the fan survey. This is anecdotal and unreliable as responses may not reflect actual sales records. So, all the other things were things that wouldn't be very reliable, or were internal, like the ticketing manager spreadsheet. And those are not as reliable as something from a third party that is external, that is kind of a trusted third party. In this case, it was a bank. So you can typically trust what's coming from a bank, most of the time. So that would be something that would be more reliable when you are trying to make sure that something is correct. So with that, let's go to the next question. All right, here we are at question 2. Again, let's read the last sentence first. Which of the following is the greatest benefit of applying audit data analytics in this scenario? Okay, let's go to the top. An auditor is evaluating sales transactions for a retail chain with hundreds of store locations. Due to the large volume of transactions, manually reviewing individual invoices would be inefficient. Instead, the auditor decides to use audit data analytics. So again, which of the following is the greatest benefit of applying audit data analytics in this scenario? Let's go through the options. Option A, it allows the auditor to test the entire population of sales transactions rather than relying on a sample. Option B, it eliminates the need for any further substantive testing. Option C, it shifts responsibility for identifying misstatements from the auditor to the client's management. Or option D, it ensures that no fraudulent transactions occurred during the audit period. So why would you apply audit data analytics in this scenario where you have, sales transactions from a retail chain with hundreds of stores? Why would you want to use audit data analytics? You could probably think through this and pick the correct answer. If not though, let's go ahead and look at the answer together. All right, here we are. The answer is A. It allows the auditor to test the entire population of sales transactions rather than relying on a sample. So let's walk through this. A key benefit of audit data analytics is the ability to analyze entire populations of transactions rather than relying on limited samples. This expanded audit coverage helps auditors identify anomalies and unusual patterns that could indicate errors or fraud. Additionally, audit data analytics enhances fraud detection by evaluating metadata, such as transaction timestamps, user activity logs, and system-generated changes, and analyzing relationships among internal and external data sources. By comparing company sales data with external benchmarks, customer purchasing trends, or supplier records, auditors can gain deeper insights into potential misstatements or inconsistencies. So essentially, using audit data analytics makes it so that you can analyze more and more efficiently so that you can catch more. You can see more connections between internal and external data sources. You can see the benchmarks. It's just easier to compare stuff and to notice things that are wrong or just notice trends. Now let's talk about the other options. Option B, and that was eliminating the further substantive testing. While analytics improve efficiency, they do not eliminate the need for additional substantive procedures when necessary. And we've talked about that. You usually can't eliminate all of the substantive procedures. And then let's talk about option C, that was shifting responsibility to management. The auditor remains responsible for identifying misstatements. Analytics serve as a tool to enhance this process. And then option D was that it ensures that no fraud occurred. And we talked about this in previous videos. While analytics improve fraud detection, they do not guarantee that all fraudulent transactions will be identified. It's almost impossible to guarantee that all fraud will be detected. So out of these options, we can tell that one of the big benefits of using audit data analytics is being able to analyze more efficiently, more quickly. So that's one of the reasons you would want to use audit data analytics. And that's kind of the idea of what we're going over in this video and the previous video and maybe the next video, talking about different aspects of audit data analytics. Now let's go to the next question. All right, here we are at question 3. Which of the following is the correct sequence of steps before using audit data analytics in this situation? So let's go up to the top. An auditor is reviewing inventory purchases for a large electronics retailer. The engagement team plans to use audit data analytics to identify unusual fluctuations in purchase quantities across different store locations. Before running the analytics, a staff auditor suggests proceeding immediately to save time. However, the senior auditor explains that certain steps must be followed to ensure reliable results. So again, which of the following is the correct sequence of steps before using audit data analytics in this situation? Let's go through the options. Option A, run the analytics to identify unusual fluctuations, then evaluate whether the data used was reliable. Let's talk about option B, validate the reliability of the underlying inventory purchase data, then plan the audit data analytics procedures, and finally execute the analytics. And then option C, plan the audit data analytics procedures, validate the reliability of the inventory purchase data, then perform the analytics. Or option D, perform the audit data analytics first, then adjust the analysis if errors in the data are discovered. So when are we supposed to be using audit data analytics and kind of what's the process for using them? So think through these, pause the video if you need to, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, plan the audit data analytics procedures, then validate the reliability of the inventory purchase data, then perform the analytics. So let's walk through this. Before using audit data analytics, auditors must first plan the procedures, determining what insights they want to gain and how the analytics will support the audit objective. However, running analytics on unreliable data can lead to misleading conclusions. Therefore, before execution, auditors must assess the reliability of the data, ensuring it is complete, accurate, and free from significant errors or bias. Once the data is validated, the analytics can be performed with confidence. So again, before you start performing data analytics, you have to plan the procedures for them, and then you have to make sure that the data you're going to be using for those analytics is reliable. You have to do those two things before you can actually perform the audit data analytics procedures. Let's talk about the other options. Option A, running analytics before assessing data reliability. This makes sense. If the data is flawed, the analytics will produce unreliable results, leading to wasted effort or incorrect conclusions. So you need to make sure that the data is reliable before you perform the procedures. Option B, validating data before planning the analytics. While data reliability is crucial, planning must come first to ensure the analytics are designed effectively. You have to know what you're trying to test. You have to know what you're trying to figure out. So you have to plan the analytics first before you check the data, because you might be checking the wrong data if you had just thought of what analytics you're trying to run before you check the data. And then option D, running analytics first, adjusting for errors later. This is inefficient, obviously, and risks drawing conclusions from incomplete or inaccurate data. All right, so when it comes to running audit data analytics, you want to plan the analytics first, then make sure that the data you're going to use is reliable, and then you can actually do the procedures. Now let's go to the next question. All right, here we are at question 4. Which of the following procedures would be most effective in detecting errors or misstatements in the payroll expense total? Let's go up to the top. An auditor is reviewing the payroll expenses of a large manufacturing company. During the analysis, they notice that the total payroll expense for the final quarter of the year is significantly lower than previous quarters, despite no known changes in workforce size or wages. To investigate, the auditor considers several procedures to determine whether the financial totals are reliable. So again, which of the following procedures would be the most effective in detecting errors or misstatements in the payroll expense total? Let's walk through this. Option A, comparing total payroll expenses to prior periods and industry benchmarks to identify unusual fluctuations. Option B, inquiring with management about why payroll expense decreased and relying on their explanation. Option C, accepting the payroll expense total as recorded since the company's payroll system is automated. Or option D, reviewing the company's budgeting process to determine whether payroll expenses were projected accurately. Okay, so which one of these would be the best for the most effective detecting of errors or misstatements in this payroll expense? So pause the video, think through this if you want, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is A, comparing total payroll expense to prior periods and industry benchmarks to identify unusual fluctuations. So let's walk through this. Analyzing financial totals through comparisons to historical data and industry benchmarks is a key audit procedure that helps detect errors, omissions, or potential fraud. If payroll expense has significantly decreased without explanation, this may indicate unrecorded payroll transactions, misclassified expenses, or processing errors. To further validate payroll totals, the auditor could use additional reliability procedures such as, so we're going to learn a little bit about different procedures that you can do to figure out the reliability of something. So they could agree payroll records to bank transfers to confirm payments were made. They could review individual payroll registers to verify completeness, or they could recalculate payroll tax withholdings to check for consistency with reported wages. So those are just a few different things that you could do to test, or these are procedures that you could do to figure out the reliability of this information. Now let's talk about the other options. Option B, that was relying on management's explanation. And as we've talked about in other videos, usually you don't just rely on management. You have to make inquiries, but you also have to corroborate with your own independent audit evidence. And then option C, assuming automation ensures accuracy. Again, you usually just can't assume that these things will be 100% accurate. Automated systems can still contain errors, and auditors must verify data rather than assume reliability. And then option D, reviewing budgeting projections. Budgeting processes help with planning, but do not confirm the accuracy of recorded payroll expenses because, again, the budget could be totally different than what actually happened. So we learned a little bit more about different reliability procedures here and what wouldn't be a very effective reliability procedure. Now let's go to the next question. All right, here we are at question 5. Which of the following would be the best procedure to evaluate the authenticity of the sales data and assess whether it may be influenced by management bias? So let's go up to the top. An auditor is engaged to audit a luxury jewelry retailer with multiple locations. The company's management provides a detailed spreadsheet summarizing total sales for the year broken down by store location. The CFO insists the data is accurate and complete, but the auditor is concerned about the authenticity of the sales data and its susceptibility to management bias, given that executive bonuses are based on reported revenue growth. So again, which of the following would be the best procedure to evaluate the authenticity of the sales data? So let's read through the options. Option A, reviewing the company's revenue forecast to determine whether actual revenue aligns with projections. Option B, confirming a sample of high-value sales transactions by obtaining direct confirmations from customers. Option C, discussing the sales growth figures with the CFO to understand how they were calculated. Or option D, performing a trend analysis to determine whether sales have increased at a consistent rate across all store locations. So based on what we've learned so far in the video, I bet you could, if you pause the video, think through this and pick the correct answer. So if you want, pause the video and do that, and we'll come back and look at it together when you're ready. All right, here we are. The answer is B, confirming a sample of high-value sales transactions by obtaining direct confirmations from customers. And this makes sense based on what we learned in one of the previous questions. Some of the best things that you can get for evidence is from external sources. When assessing authenticity and management bias, auditors should seek independent evidence that validates reported transactions. Direct customer confirmations provide strong external evidence by verifying that sales actually occurred as recorded. This reduces the risk that management has overstated revenue to meet performance targets. Additional procedures to assess authenticity and bias include, so let's talk about the other procedures that you can do. You could compare recorded sales to cash or credit card deposits to ensure revenue was actually received. You could review contract terms for large or unusual sales to check for premature revenue recognition. Or you could assess adjustments or manual journal entries in revenue accounts for signs of manipulation. So those are some other things that you could do to assess authenticity and bias. So let's talk about the other options and why they weren't as good. Option A, comparing revenue to forecasts. Forecasts are based on estimates and do not confirm whether sales actually occurred. Same thing, kind of the same thing as with budgeting. The budget might be very different than what actually happened. Option C, discussing with the CFO. Management's explanations must be verified with independent audit evidence. And then option D, performing trend analysis. Identifying patterns is useful, but does not authenticate individual sales transactions. So we learned quite a bit about audit data analytics and things that you would want to do to kind of verify and increase the reliability of them throughout this video. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you about the different reliability procedures that you can perform, or whatever the case is. Again, these are the things you notice throughout the questions, so you write them down in your own words as the pillar topics based on the questions you learned from. And as you're doing this each day, you're going to build your own personal repository of the most important things you need to know for the exam, again, based off of what you learned from the questions in your own words. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics, and I hope these will be helpful because I do feel like this is kind of a really broad but kind of strange topic in the blueprints. So I wanted to go over these pillar topics to make sure that you understand kind of what we were meant to learn from those questions so that you can kind of maybe go back and look and see, oh, that's what I was trying to understand in that question. So let's go ahead and go through these pillar topics. The most reliable audit evidence comes from external independent sources. Auditors should prioritize third-party confirmations, reconciliations to external records, that would be things like bank statements, and direct verification over internally generated reports or management representations. Now let's talk about the next one. Audit data analytics should only be performed after ensuring the underlying data is reliable. Before executing analytics, auditors must assess data completeness, accuracy, and susceptibility to bias to avoid drawing misleading conclusions from flawed information. Now let's talk about the next one. Analyzing financial totals can reveal misstatements, but further reliability procedures are needed for verification. Unusual fluctuations in account balances should prompt auditors to perform additional procedures such as tracing transactions to source documents, reconciling subledgers, or confirming balances with third parties. Now let's talk about the next one. Auditors must assess the authenticity of financial data and its susceptibility to management bias. When management has an incentive to manipulate financial results, auditors should verify recorded transactions through contracts, invoices, independent confirmations, and review of manual journal entries. And then let's talk about the final one. Selecting the right reliability procedure depends on the audit objective and the type of data being tested. Procedures like confirmations, reconciliations, cutoff testing, and contract reviews are chosen based on the risks involved and the best method to validate data accuracy and completeness. So again, those were the pillar topics for this video. Those were kind of the main things that we were hopefully learning from those questions. And again, I feel like it's kind of a difficult topic. It's kind of a strange, broad, but also super narrow topic in some ways. So I hope that these pillar topics help with that. Now, before you go, that is the end of this video. So make sure you check out becoming a SuperFast CPA Pro member on SuperfastCPA.com. Remember, they are going to get access to the full 10 question versions of these videos. So you're only going to get 5 questions right here. But if you become a SuperFast CPA Pro member, the full version of this video is going to be posted in the SuperFast CPA member forum. So again, if you become a SuperFast CPA Pro member, you'll get access to the full videos. And again, the easiest way to do that is by going to SuperfastCPA.com, sign up for the free webinar, learn about SuperFast CPA, and then you'll have a great path to becoming a Pro member. I hope this video was helpful. If you did like the video, make sure to like it and leave a comment. I will see you in the next video.